Hey Bowtie Nation, Joseph Hogue here with a very special 2024 investing video. You know real estate will always hold a special place in my portfolio, but more than that, real estate stocks could be entering an era of outsized returns. With real estate investment trusts or REITs down 25% in 2022 and another 12% last year through October, investors forget that we've heard this story before. When REITs crumbled 42% in the 2008 crash, the sector went on to be one of the best returns in the market, with real estate stocks producing 200% return over the next 6 years. In fact, real estate stocks jumped 20% in just the last 2 months of the year, more than double the return over the overall market. And that is just going to be the beginning of what could be a multi-year rally in real estate stocks. I'm going to explain why that is, along with the highest paying REITs I'm buying for an average 9% dividend yield plus upside returns. We'll start with everyone's favorite monthly dividend REIT here, the only REIT in the Dividend Aristocrats list. Realty Income, ticker O, is actually the lowest dividend in this list though, at just 5.4% yield. Realty Income has 50 years of operating history and owns nearly 6,000 properties in 49 states, Puerto Rico, and the United Kingdom. And even though 83% of the rental revenue here is from retail stores, I'm okay with this one because it's diversified across some of those safer types of retail properties like convenience, dollar stores, drug and grocery. Lease terms average 9 years, and occupancy has never been below 96% for these properties. Rent growth isn't terrifically strong here at about 1% annualized, but it's consistent and does support that dividend. The company just made its 122nd dividend increase here, a monthly payer investors love, but to be honest here, the dividend yield just squeaked by on this list. It's a consistent payer, but pulls the average down, so feel free to replace this one with a higher yielding stock if you want from the list. We'll get right back to that list of real estate stocks to buy, but I'm also investing in real estate through the Arrived Homes platform. Rental property is one of the best cash flow investments you can make, but it is such a pain to manage. Seriously, if you haven't been woken up at 3 a.m. to light the pilot light on a tenant's water heater, you haven't known the joy that is managing your own rental properties. But Arrived makes rental properties easy, investing in individual homes with each investment set up as an LLC, so you have a direct investment. You earn dividends on the rental income paid out every quarter, with dividends from 3 to 8% on rent, and then price appreciation when the property is sold. Upside price returns have been as high as 136%, and usually over that 5 to 7 years. I'm sure you have a lot of questions. I know I did before I started investing, and I want you to make your own decision if you should invest, if this is right for you. So I'm going to link to Arrived Homes in the description below. One thing though, the homes available for investment sell out fast, so make sure you click through and just get on the notification list. I missed out on a lot of good properties for not being on that notice list, so look for the link below. Gaming and Leisure Properties, ticker GLPI, with its 6% dividend, is in one of the strongest trends over the last couple of years and should continue to do well. The company owns 52 properties in 17 states, many without a competitor for more than 60 miles. Its casinos are operated by some of the biggest names like Caesars, Boyd, and Penn National, with gaming and over 15,000 hotel rooms. And besides the growth in gambling that we're just starting to see across the United States, I really like the company's strategy here. It contracts with operators on a triple net basis, an NNN basis, so the companies pay all the costs, including maintenance. Strong contract terms means GLPI has been able to keep 100% occupancy since its inception. I'll highlight later why I think the opportunity in healthcare is better than any other next, but here we're adding LTC Properties, ticker LTC, and it's almost 7% dividend yield. The real estate trust owns 180 properties in 27 states, with skilled nursing accounting for 56% of the revenue and assisted living centers bringing in the rest. Now, senior living facilities took a hit starting around 2016 on just oversupply and construction, and then got slammed during the pandemic, but LTC managed to maintain and even grow its dividend. Occupancy has stayed higher than peers, and long-term, this is a great play on America's aging population and the demand for senior living facilities, and the stock is selling at a discount here. That dividend yield of nearly 7% is safe, and I think you get another 5 to 10% a year in price appreciation as well. Now folks, it doesn't take a fancy bow tie or 10 years as an equity analyst to understand why real estate is primed to rally. The sector crashed on the Fed's fastest interest rate hikes in 40 years, and just as investors were surprised to the downside, I think the market has a surprise coming to the upside as well. Those higher interest rates are like kryptonite for real estate. Commercial property is typically financed with 70% debt, and on loans where only the interest is paid over the 3 to 5 year period. Rates have doubled over the last 2 years, so property owners needing to refinance then are finding those higher interest expenses that are just going to wipe out the cash flow on properties. So a lot of owners are just letting those properties go back to the bank, destroying valuations for other properties. So even if the owner wants to refinance. Many can't because prices have dropped so much that the banks won't refinance without more money put in as collateral. We're likely to see property values keep falling through much of 2024, but just as those rising rates started this mess, those Fed rate cuts expected soon are going to start a new boom. We're already seeing private equity and institutional funds raising money to scoop up those bargains. Private equity giant Blackstone is raising $2.6 billion to buy distressed properties, and it's estimated that opportunistic real estate funds have more than $145 billion in cash set aside for buying. So that means even before those interest rates actually start coming down, we're going to see property values start heading higher as all these buyers start coming in and those real estate stocks take off. So I want to walk through which property types I'm watching for the best opportunities along with the stocks I'm highlighting in this video. And just like all real estate is local, returns on REITs are highly dependent on that property type. So please spend a little time here to understand which property types are going to do well and which could still be in for more pain. You see here in NAREIT data, the National Association of REITs returns for 2022 and last year broken down by property type. That massive plunge when the Fed started raising rates and where the opportunities are for real estate stocks. Office property was down both years, and there could still be more pain to come here. Besides that interest rate story, office hours occupancy is still about half of what it was pre-pandemic and will never recover. As those old leases expire, even the companies still needing some space are going to downsize, so we're going to likely have at least another year before the office space hits bottom. Now that means avoiding those pure office REITs like SL Green, Vornado, and Boston Properties. Here we see NAREIT data on the real estate stocks in the office segment, so you can see the stocks that are in this segment. Retail properties actually done pretty well with the exception of malls, which will probably continue to die that slow death against online shopping. But other types of retail like smaller shopping centers and convenience stores could do well, like this property held by the monthly REIT favorite Realty Income, that's ticker O. Now I have residential real estate exposure and single family rentals on arrived, so I don't usually invest much in apartments. There is a huge supply of new apartments finishing last year and this year, so that could weigh on rents and the stocks you see here in the apartment REITs. Again, healthcare is one of my favorite property types here. Not only did the properties get hit on those interest rates, but also weakness in profitability for healthcare services. But as hospital profits rebound, and we're already starting to see that, and those rates fall, you could get a double boost to these REITs in this group, like Medical Properties Trust, ticker MPW, Omega Healthcare, and Sabre Health. I also like the infrastructure REITs, which are those cell tower real estate stocks like American Tower, that's ticker AMT, and Crown Castle. In fact, we highlighted Crown Castle, ticker CCI, in a mid-October video, and it was up 21% to the end of last year. Data centers already had a strong rebound, up 32% last year, and were the best performing property type, benefiting from that idea that artificial intelligence is going to mean a surge in data and storage needs. That trend should continue through the decade, so I'd be looking at REITs like Digital Realty Trust, that's ticker DLR, and Equinix, ticker EQIX. And finally, before we get back to that list of REIT stocks, gaming REITs, which are fairly new here, but also seeing a strong trend as more states open up to legalized gambling. So I bought more gaming and leisure properties, ticker GLPI, on that focus. Back to our list of REIT stocks though, and another healthcare name here with Global Medical REIT, ticker GMRE, and its 7.5% dividend. Here GMRE is more focused on the medical office and inpatient rehab facilities than hospital owner MPW, which I also own, but Global Medical has strong occupancy, and medical office hasn't seen that same work from home destruction that we've seen in the general office space. Now this is a smaller REIT, and maybe you don't need both GMRE and MPW, but I like the healthcare space, so I think both of these do well. GMRE has done much better with shares up 18% over the last year, and the company didn't cut its dividend through the pandemic. So it's certainly a safer way to benefit from the healthcare REIT trend than MPW, though at maybe not the upside return if the segment does rebound next year. I'm going to highlight MPW later in the list to help you choose. Gladstone Commercial, ticker GOOD, fell out of favor last year, but is still a solid monthly dividend payer and a 9.2% dividend yield. A longtime favorite, this real estate investment trust shocked investors last year with a surprise cut after years of dividend growth. While that surprise dividend cut did hit confidence for the stock, cash flow is now secure, the dividend is safe, and investors could be in for a strong upside cash flow over the next years. Remember, we did see all real estate stocks get hit, falling 25% in 2022 on those higher interest rates and down more than 6% last year. So Gladstone held out longer than most, but just had to cut that dividend to protect cash flow. Gladstone is a real estate investment trust with over 17 million square feet of industrial and office space for $1.2 billion in assets. That is spread across 135 properties in 19 industries and 27 states. Now again, I'm not positive on that office segment of the company, but the industrial side does balance it out until office eventually starts to rebound as well. We still got one more real estate stock, one paying 14% dividend, but make sure you watch the video here in the corner for my full 2024 investing plan. I'm going to reveal where the best opportunities are in stocks, along with 10 stocks I'm buying for double-digit returns. Mortgage REITs like AG&C Investment, ticker AG&C, have the most to gain on those lower interest rates and could produce a big upside on top of the 14.7% dividend. Now, that high dividend yield is tough to pass up, but the shares have fallen 13% in the past year, and the dividend has been cut twice in the last 5. Still though, AG&C is what they call the best house in a bad neighborhood. You see, all mortgage REITs or REITs have been hit hard on those higher mortgage rates, but this one has held up better than the rest. It's cut its dividend fewer times and by not nearly as much. You can see here other REITs like Armour and Ellington cut their dividend 15 and 26% on an annualized basis, while AG&C has only cut about 8% annualized. Remember, a mortgage REIT or an REIT is a special type of real estate companies. It doesn't own the actual real estate like a lot of these other REITs. These REITs borrow money on short-term rates and then leverage that up, borrowing 2 or 3 times that amount to invest in longer-term mortgages. Now, when interest rates rise, like they have over the past couple of years, not only does the borrowing costs increase for these REITs, but also those long-term mortgages that they're holding lose their value. Basically, it's a bond portfolio. The upside to this is that as those rates come down, which they will this year, this effect is going to work in reverse and boost shares of REITs like AG&C, which is the strongest in the bunch. The company holds a $61.3 billion portfolio of these mortgages, 91% of that in 30-year fixed terms, and most of those in safe agency-backed mortgages. So as that mortgage market levels out with these lower rates, we're going to start seeing AG&C shares rise along with the dividend payment. Look for the link below to see the new way I'm investing in real estate on arrived homes, earning cash flow on rental properties without the hassle. Or click on the video to the right for my complete 2024 investing plan. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.